Hello everyone, today is the 30th of April 2025 and this is the Just Dario Daily. The title of today's daily is How the UBS Titanic Keeps Floating Despite the Hole in its Hull. UBS just delivered another earnings expectations beat. What a surprise, right? If it wasn't for the Swiss regulator, who is aware of the bank's real condition and doesn't back off from asking UBS bank management to significantly increase their capital to prepare for potential significant losses, the market as a whole would have no concern whatsoever about the bank's health, considering the headline numbers it continues to deliver. These numbers are, once again, incredibly misleading. As I flagged in my last analysis on UBS, why the situation of UBS is very dangerous, the bank made virtually zero money from being a quote-unquote bank, meaning collecting money from the public and then lending it out. In this last quarter, UBS made roughly $6.9 billion in interest revenues from lending activities, while incurring in roughly $6.9 billion in financing costs to fund the activity, delivering, once again, zero returns from the banking business. Who saved the day? UBS trading division, of course, which brought in roughly $1.6 billion of revenues. Roughly flat compared to Q1 24, but down 16% compared to Q4 24. Another interesting thing we spotted in my last analysis was how the Swiss National Bank continues to actively support UBS by easing interest rates and loosening financial conditions. Once again this quarter, this was of great help to UBS, which could record roughly $4 billion of other net income gains from assets measured at fair value through profit or loss. Interestingly, this is an income statement item the bank keeps providing no further detail about, despite accounting for 33% of its total revenues. Last quarter, I highlighted a significant cash bleed from UBS. Did the situation improve 3 months later? At first glance, it seems the situation slightly improved in the past 3 months, with cash and equivalents increasing roughly $8 billion to roughly $231.4 billion. However, this looks more like the result of bold window dressing than a real improvement in the bank's health. This quarter, the bank reported $744.9 billion of deposits, roughly $1 billion lower than the previous quarter, but $58.4 billion of short-term borrowings, up $4.5 billion quarter on quarter. Furthermore, the net amount of money UBS borrowed from other banks increased from $4.4 billion to $6.7 billion in the current quarter. Clearly, UBS had to finance itself from more expensive and short-term funding sources to beef up its cash position and give the impression it stopped bleeding cash. However, the bank's effort is betrayed by another decrease in deposits. Now, let's measure again the size of the hole in UBS books, shall we? As of Q1 2025, UBS reported at $1.234 trillion total risk exposure to banking and traded products, roughly $20 billion higher than the previous quarter, with the bulk of the increase due to new loans to customers. Incredibly, the total amount of allowance for expected credit losses UBS set aside to face a potential economic downturn and increase in defaults remained virtually negligible at $2.6 billion or 0.21% of its total risk exposure on this front. Considering the roughly $7 billion interest earned this quarter, we can extrapolate a 2.27% interest income on all UBS banking and traded products. Keeping a 5-year duration assumption for consistency with the last analysis, current rates, the mark-to-market value of these assets held by the bank implies a roughly $98 billion unrealized loss against $87 billion of equity in UBS balance sheet. Yes, a slight improvement compared to 3 months ago. However, let's not forget this estimate only takes into consideration mark-to-market losses due to movement in rates, which this quarter has been beneficial to the bank, not credit spreads. Hence, it can fairly be considered an underestimation. As you can read from UBS' own outlook, due to tariffs, uncertainties and risks are expected to increase. As a consequence, credit spreads are bound to increase, reflecting the rise in risk in the overall economic environment and the likely increase of corporate defaults. What do you think will be the impact on UBS books in such a situation? It is fair to conclude that the bank is totally unprepared to deal with a worsening economic environment, having only set aside a ridiculously low allowance for expected credit losses and already carrying a substantial amount of unrealized losses in its hold-to-maturity books. At the same time, its core operations are already unprofitable, and the bank relies every quarter on trading profits and fair value adjustments to deliver a positive net income. Swiss regulators' concerns are more than justified, but the risk that things quickly deteriorate here is high, and that concern can swiftly turn to desperation because, as of now, Switzerland cannot afford to bail out UBS. Thanks a lot for listening to my podcast again today, for liking, commenting, and subscribing to my YouTube channel, for supporting me on X, and for reading and commenting the articles on my blog, justdario.com. Talk soon.